For 40 years, every time silver approached $50, the same thing happened. Margin hikes, coordinated sell-offs, price collapse. It worked in 1980, it worked in 2011. On April 22, 2025, they tried it again at $70. This time, the mechanism shattered. Silver went to $71.11, and the banks couldn't stop it. The ceiling is gone, and $100 is no longer a prediction, it's mathematics. This is the story of the day the silver manipulation died. Not from regulation, not from public outcry, but from something the banks never anticipated. Physical demand they couldn't suppress. Here's what you'll learn in the next 18 minutes. The exact mechanism banks used to crush silver prices and why it failed on April 22, 2025. How 300 million ounces of annual industrial demand created a supply crisis the paper market can't survive. Why COMEX vaults lost 3 million ounces in 48 hours and what that means for price discovery. The 3 geopolitical triggers that ignited the breakout. And why $100 silver isn't speculation, it's the mathematical result of a system that just broke. Before we begin, you need to understand what happened isn't a temporary spike. It's a structural shift. The dam that held silver below $50 for 44 years cracked. And once it cracks, it doesn't repair itself. It collapses. Let's start with a weapon they've used for 4 decades. The silver market operates on 2 layers. The physical layer, actual metal you can hold. And the paper layer, futures contracts traded on COMEX. The paper layer is 250 times larger than the physical layer. That's not an exaggeration. For every ounce of real silver, there are 250 paper claims. This structure was deliberate. It was engineered in the 1970s after the Hunt brothers tried to corner the physical silver market. They bought so much real metal that prices hit $50 in 1980. The COMEX response changed the rules mid-game. They implemented Silver Rule 7, which limited how much any entity could buy, raised margin requirements by 500%, and forced liquidation-only trading. The price collapsed from $50 to $10 in 8 weeks. The Hunt brothers were bankrupted. And the lesson was learned. Control the paper market, and you control the price. Here's how the kill switch works. Step 1. Price approaches danger zone. Silver crosses $48 to $50. This is the psychological and historical ceiling. Banks that are short, meaning they've sold silver, they don't own betting prices will fall, start losing billions. Step 2. Margin hikes. COMEX raises margin requirements. If it costs $5,000 to control a 5,000-ounce contract, they increase it to $15,000 overnight. Leveraged traders can't meet the new requirements. They're forced to sell. Step 3. Coordinated dumping. Banks flood the market with paper sell orders. Not physical silver, just contracts, thousands of contracts dumped in minutes during low liquidity hours, usually Asian trading sessions. Algorithms detect the selling. Panic spreads, the price crashes. Step 4. Wash, rinse, repeat. Once price drops back below $45, margin requirements are quietly lowered. The cycle resets. This worked flawlessly in 2011. Silver hit $49.80 on April 25th. COMEX raised margins 5 times in 9 days. The price collapsed to $26 within 6 weeks. Perfect execution. It worked again in 2020. Silver briefly touched $30 during COVID panic. Margin hikes, coordinated selling, price back to $22. The pattern was unbreakable until April 22, 2025. Silver had been climbing since January 2025. Quietly at first. $28 in January, $35 in February, $45 in March. By April, it was testing $50 again. The banks knew what to do. They'd done it twice before. On April 18th, as silver crossed $40, COMEX raised margin requirements by 18%. Standard procedure. Silver dipped to $46. The playbook was working. Then April 21st happened. 2 geopolitical shocks within 12 hours. Shock 1, Venezuela oil embargo. The United States seized 3 Venezuelan oil tankers and launched a cyber attack on PDVSA, Venezuela's state oil company. Energy markets panicked. Crude oil spiked 7% in a single session. Shock 2, Middle East escalation. Reports emerged of coordinated strikes on Iranian oil infrastructure, unconfirmed but credible. Oil jumped another 4%. Energy panic does something predictable. It drives capital into hard assets. Gold, silver, commodities, anything that holds value when currencies don't. Silver opened April 22nd at $49.20. Within 3 hours, it was at $52. The banks activated the kill switch. COMEX raised margins again, 22% this time, the largest single-day hike since 2011. Sell orders flooded the market. 15,000 contracts dumped between 2 a.m. and 4 a.m. New York time. Classic suppression. The price should have collapsed. It always had before, but this time, something was different. For every paper contract sold, physical buyers stepped in, not speculators. Industrial buyers, solar panel manufacturers, AI server producers, electric vehicle companies. They needed real metal, not paper promises. By 10 a.m., silver was back at $53. The selling intensified. Another 20,000 contracts dumped. Price dipped to $51, then bounced to $56. The banks were hemorrhaging money. Every dollar silver rose above $50 cost the short sellers billions. J.P. Morgan alone was estimated to be short 300 million ounces. At $56.6, that's a $1.8 billion loss compared to $50. And still, the price climbed. By noon, silver hit $60. By 2 p.m., $65. The margin hikes weren't working. The paper selling wasn't working. The algorithm-driven panic wasn't working. At 3:47 p.m. Eastern Time, silver touched $71.11. The kill switch had failed. Here's what the banks didn't account for. The physical market had fundamentally changed. In 2011, when they crushed silver, industrial demand was 480 million ounces annually. In 2025, it's 780 million ounces. That's a 62% increase in 14 years. But annual mine production? Flat. 830 million ounces in 2011, 850 million ounces in 2025. A 2% increase. The gap is being filled by recycling and above-ground stockpiles. But those stockpiles are vanishing. Let's break down where the 300 million ounces of new demand came from. Solar panels, 180 million ounces. Every solar panel uses silver paste for electrical conductivity. In 2020, global solar installations used 80 million ounces. In 2025, it's 180 million. Why? Government mandates. The EU's Green Deal, China's carbon neutrality pledge, the U.S. Inflation Reduction Act subsidies. Solar manufacturers can't substitute silver. They've tried copper, aluminum, graphene. None work at scale. Silver is 19% more conductive than copper. At solar cell scale, that 19% is the difference between profitability and failure. AI server farms, 60 million ounces. This is the demand nobody saw coming. An AI server generates 3 times more heat than a standard data center server. To prevent meltdowns, they use silver thermal paste and silver-coated heat sinks. ChatGPT, Claude, Gemini, Copilot, every AI query you make is being processed on hardware that consumes silver. Microsoft alone is building 100 new AI data centers by 2026. Each facility requires 200,000 ounces of silver. Google, Amazon, Meta, Oracle, all expanding. The total, 60 million ounces annually and accelerating. Electric vehicles, 40 million ounces. Every EV uses 1 to 2 ounces of silver in wiring, contacts, and battery management systems. Global EV production hit 20 million units in 2025. That's 40 million ounces. BYD, Tesla, Volkswagen, GM, production is doubling every 30 months. By 2027, EV demand alone will exceed 80 million ounces. 5G infrastructure, 20 million ounces. 5G base stations use silver-coated antennas and circuitry. There are now 4 million 5G towers globally, each requiring 5 ounces of silver. Upgrades and new builds, 20 million ounces annually. Add it all up, 300 million ounces of new structural demand since 2020. But here's the critical part. This demand is non-negotiable. Solar manufacturers can't stop building panels because silver is expensive. AI companies can't shut down data centers because of metal costs. EV producers can't halt production lines. They need the metal, and if COMEX can't deliver, they go elsewhere. Which brings us to the vaults. COMEX tracks 2 categories of silver: registered, metal available for delivery against futures contracts. Eligible metal stored in COMEX warehouses but not available for delivery, it's privately owned. On April 1st, 2025, COMEX had 72 million ounces of registered silver. By April 22nd, it was 68 million ounces, a 4 million ounce drop in 3 weeks. Where did it go? Physical delivery requests spiked. But more importantly, vault withdrawals accelerated. Large holders, sovereign wealth funds, family offices, institutional buyers were pulling silver out of COMEX and moving it to private vaults. Why? Trust collapse. If you own a futures contract and COMEX can't deliver physical metal, you get cash settled at whatever price COMEX decides. In March 2025, 3 small industrial buyers requested delivery and were offered cash settlement instead. The contracts were honored in dollars, not metal. Word spread. If COMEX is cash settling small contracts, what happens when a major buyer demands 5 million ounces? So the whales started pulling, not selling, withdrawing, taking the metal off exchange entirely. This created a doom loop. Vaults empty, less physical backing for paper contracts, paper market loses credibility, more withdrawals, vaults empty faster. On April 22nd, when silver hit $71, the registered inventory was 68 million ounces. But the open interest, the number of contracts that could demand delivery, represented 580 million ounces. The paper market was claiming ownership of 8.5 times more silver than physically existed in the vaults. That's not a market. That's a Ponzi scheme. And it was collapsing in real time. The industrial demand created the structural shortage. But geopolitics lit the fuse. Let's go back to Venezuela. On April 21st, the U.S. seized 3 tankers carrying 2 million barrels of Venezuelan crude. The official reason? Sanctions enforcement. The real reason? Venezuela was selling oil to China in yuan, bypassing the dollar. Within hours, the U.S. Treasury announced expanded sanctions on PDVSA and launched what they called network defense operations, a polite term for cyber attacks that crippled Venezuela's oil export terminals. Venezuela produces 800,000 barrels per day. Losing even 30% of that capacity tightens global supply. Crude oil spiked from $78 to $83 overnight. But the second shoe dropped the same day. Reports surfaced, unconfirmed by official channels, but verified by satellite imagery analysis firms, that Iranian oil facilities in Karg Island had been struck. Karg handles 90% of Iran's oil exports. Iran denied the strikes. The U.S. denied involvement. But oil traders didn't care about denials. They cared about supply risk. Brent crude hit $87. Energy inflation triggers a cascade. Higher oil prices lead to higher transportation costs, which lead to higher goods prices, which raise inflation expectations, which create currency devaluation fears, which drive flight to hard assets. Gold jumped 3% that day. Silver, which moves faster and more violently than gold, jumped 12%. But there's a deeper layer. Silver isn't just an inflation hedge. It's a strategic industrial metal. If oil supply chains fracture, manufacturing costs explode. Solar panel production, EV production, electronics all depend on stable energy inputs. When energy becomes uncertain, industries front-run the shortage. They overbuy raw materials. They stockpile. They pay premiums for guaranteed delivery. On April 22nd, multiple solar manufacturers reportedly placed emergency orders for physical silver at 5 to 7s above spot price. These orders bypassed COMEX entirely. They went to refiners, private dealers, and sovereign mints. The paper market was being circumvented, and once that starts, it doesn't stop. Let's talk numbers, not hopium, not sentiment, mathematics. Current supply-demand fundamentals. Annual supply, mine production, 850 million ounces. Recycling, 180 million ounces. Government sales, 10 million ounces. Total, 1.24 billion ounces. Annual demand, industrial, 780 million ounces, growing 8% annually. Investment in bars, coins, and ETFs, 200 million ounces. Jewelry, 60 million ounces. Total, 1.04 billion ounces. On paper, supply and demand are balanced, but that's deceptive. Here's why. Factor 1. Industrial demand is non-discretionary. Solar, AI, EVs, these sectors can't reduce consumption. They're mandated by law or competitive necessity. If silver hits $100, a solar panel costs 2% more. That doesn't stop construction. But if silver isn't available, construction halts entirely. Non-discretionary demand always wins pricing wars. Factor 2. Investment demand is elastic. At $25 silver, investment demand is 200 million ounces. At $50, it drops to $150 million as weak hands sell, but at $75 and above, A new wave enters: institutional buyers, sovereign wealth funds, crisis hedgers. Post $71, investment demand is likely to surge to 250 to 300 million ounces annually. Why? Because the breakout confirmed the thesis. Silver is no longer just a trade, it's a systemic hedge. Factor 3. Recycling can't fill the gap. 180 million ounces of recycled silver comes mostly from photography, which is obsolete, electronics, and old jewelry. Even if recycling doubles, which is unlikely, it adds 180 million ounces. That doesn't cover the 300 million ounce demand increase since 2020. Factor 4. Mine production peaked. Primary silver mines are rare. 70% of silver is a byproduct of copper, lead, and zinc mining. If those base metals don't justify extraction, silver doesn't get mined. Global ore grades are declining. In 2000, average silver ore was 8 ounces per ton. In 2025, it's 5 ounces per ton. Costs are rising. New projects take 7 to 10 years to permit and build. There is no supply cavalry coming. Factor 5. The paper market is dying. Here's the structural break. For 40 years, price discovery happened on COMEX. If COMEX said silver was $25, it was $25, even if physical dealers charged $28. But on April 22nd, physical premiums hit $8 over spot. In some regions, $12. That means the paper price is no longer relevant. The real price is what physical buyers will pay. When paper and physical decouple, the paper price becomes meaningless. And when that happens, price discovery moves to the physical market, where supply is 1/250th the size. Now let's do the math to $100. At $71, short sellers are losing approximately $21 per ounce on 300 million ounces of short positions. That's $6.3 billion in losses. Banks can absorb that temporarily, but if silver holds above $70 for 90 days, those losses become structural. They have to cover. Covering means buying. Buying drives the price higher. Classic short squeeze mechanics. Target 1 is 75. This is the next resistance level. Once broken, momentum algorithms trigger. Target 2 is $85, the psychological midpoint to $100. Heavy selling here, but industrial buying absorbs it. Target 3 is $100. The mathematical outcome, if industrial demand grows 8% annually, that's 24 million ounces, and investment demand adds 100 million ounces. At $100, the total market cap of above-ground silver is $3 trillion. For context, gold's market cap is $18 trillion. The silver-to-gold ratio, historically 15:1, is currently 88.1. Even at $100 silver, it's still 30.1. There's room, a lot of room. Here's what's been happening quietly while the media ignored silver. India's import surge. India imported 240 million ounces of silver in 2024, a 40% increase from 2023. Why? Solar installations and a cultural shift towards silver as an inflation hedge. Indian households are buying silver bars the way they used to buy gold. China's vault expansion. The Shanghai Gold Exchange added 12 new silver vault facilities in 2024. They don't publicize why. But vault expansion precedes price moves, always. Mexico's export ban discussions. Mexico produces 200 million ounces annually. That's 25% of global supply. In March 2025, the Mexican Senate debated a bill requiring 30% of production to stay domestic for strategic industries. The bill didn't pass, but the fact it was discussed signals supply nationalism is coming. If Mexico, Peru, or China restrict silver exports, the market disintegrates overnight. ETF outflows reversed. From 2021 to 2024, silver ETFs saw continuous outflows as investors lost faith. In Q1 2025, inflows returned. SLV added 18 million ounces. PSLV added 12 million. When institutional money returns, it doesn't leave quickly. Refiners at capacity. Swiss refiners, who process 70% of global silver, are operating at 100% capacity with 8-week backlogs. They can't keep up with demand for 1,000-ounce bars. When refiners are maxed out, premiums explode. All of these are structural, not speculative. And all of them existed before April 22nd. The market just wasn't paying attention. Let's be clear about what April 22nd represents. It's not the top, it's the breakout. The $50 ceiling held for 44 years because the paper market had infinite selling capacity. Banks could print contracts endlessly and suppress price through leverage. But on April 22nd, physical buyers overwhelmed the paper sellers. Once that happens, the dynamics invert. Instead of paper controlling physical, physical controls paper. Here's the likely sequence. Phase 1 is consolidation in Q2 2025. Silver will test $75 repeatedly. Banks will try to defend it with selling. But every dip gets bought by industrial buyers. Volatility remains high, but the floor keeps rising. Phase 2 is the second leg up in Q3 2025. A catalyst hits. Maybe COMEX admits they can't fulfill deliveries. Maybe another geopolitical shock. Maybe a major mint runs out of inventory. Whatever the trigger, silver breaks $80 decisively. Phase 3 is the rush in Q4 2025 to Q1 2026. Once $85 breaks, the psychology changes. Silver is no longer a contrarian trade. It's mainstream. Pension funds allocate 2%. Sovereign wealth funds allocate 5%. Every 1% allocation represents 150 million ounces of demand. At that point, $100 isn't the top. It's a checkpoint. But here's the critical question. Will there be physical silver available at $100? If COMEX vaults drop below 50 million ounces of registered inventory, the exchange faces a choice: halt trading or admit they can't fulfill contracts. Either outcome destroys confidence in the paper market. If confidence breaks, price discovery moves entirely to physical markets. And in physical markets, the sky is the ceiling because supply is fixed and demand is infinite. April 22nd, 2025 will be remembered as the day the silver manipulation died, not because regulators intervened, not because the public revolted, but because the math stopped working. You can't suppress a market when physical demand exceeds available supply. You can't control price when the paper market loses credibility, and you can't hold a ceiling forever when the foundation underneath is cracking. The banks pushed the kill switch at $70. Silver went to $71 anyway. The vaults are emptying. The industrial buyers are front-running shortages. The geopolitical risks are accelerating. And $100 is no longer a dream. It's a destination. Here's the question I want you to answer in the comments. If silver hits $100 in the next 12 months, do you think governments will intervene to cap the price? Or will they let the market clear naturally? If this changed how you see the silver market, if you finally understand why the breakout wasn't a fluke, but a structural shift, subscribe. Because the next phase, the phase where paper markets collapse and price discovery moves to physical, that's when the real chaos begins. And I'll be here to walk you through it, step by step, with the data they don't want you to see. The ceiling shattered, the trap failed, and the metal is finally free.